Take a look at this graph. This is the COT report for Australian dollars since January 2025, and it's showing one direction across all commercial traders on the TFF report. Now take a look at this other graph. This is the same COT report for the US dollar, and we're looking at the three commercial traders in the TFF report. One thing stands out here. It seems like you should not be buying the US dollar against the Australian dollar, right? But this is the graph on the daily, and now we have a whole new picture that says the market is not moving. So if the COT report is not enough to determine a bias, then what is enough?
Now, as always, this is not financial advice. This is just me running you through my opinion and why I think that opinion is very, very valuable. So without further ado, let's just head right into it.
For you to accurately choose a side on the market, you need to see both sides of the coin. And when I say both sides of the coin, I mean look at both markets and also look at the entire data of both markets. What we have right here is the market check for the Australian dollar. I'm looking to improve this dashboard, and I would love to hear your comments in the comment section below on how to make it much more appealing to viewers, as I think it is not so appealing as it is right now. However, I digress. Let's take a look at what the details say. So in the recent 1 month span, since the 2nd of May to date, we've had some good news and some bad news. We've had PMI data, and the global PMI manufacturing data has been quite good in the most recent June 1st release, which is today. But the last service data was kind of bearish. Looking at the employment data, we have weak employment data in recent time, and the central bank remains neutral with their stance at a certain price. Putting all of this together, where we currently stand in the market is we stand at a low scored market. Now, the last thing we need to look at for is what has the COT traders been doing recently. Personally, I follow the leverage fund, even though I still manage to track the asset managers. But one thing you can see is there's a faint blue line here that shows the asset managers, and it seems like they have been reducing that position down to about 56%. While the asset managers have increased their longs, the leverage fund managers have increased their longs, while the retail traders or the non-reportable traders are still heavily long in this Australian dollar market. Compare that against the US dollar, where we have an overall score of 59, and in the recent 14 days, the score is not so good at 41%. We've not got any recent central bank details, but in recent time, we've gotten the manufacturing PMI being bearish and the ISM manufacturing PMI being bullish. We also got GDP for economic activity being bearish. And this marks up the latest set of news, and the service PMI being bearish. For employment data, we have unemployment rate being neutral, but the non-farm payroll being bullish. And last but not least, we look at the inflation data. We have the core PCE price index month over month being bearish, the core PCE price index being neutral, that's year over year, and the core PCE price first quarter, right? The core PCE price being bullish, while the core CPI, that is inflation data, month over month is bullish, as well as the CPI year over year and the core CPI year over year also bullish. So all overall, this gives a good stance for the US dollar in terms of economic data releases. But for the COT stance, and looking at the whole situation with the COT traders, we have the leverage fund traders having more short trades in the contracts than long contracts, putting them in a bearish sentiment. We have also the asset managers going heavily long on this market, as well as the leverage fund, as well as the retail traders going quite long on this trade. So what's happening here is we can clearly see that the leverage fund traders are shorting the market despite every other set of trader kind of going long in this market. That is looking like a conflict of interest to an extent, but then again, the leverage traders are people who move fast pace with what is really going on right now. So if you look at the US dollar right now, it's quite unstable. So therefore, it makes sense that the leverage funds traders would be shorting the market to an extent for now. we'll go straight for the Australian dollar against the US dollar. And what we see here is we do have a slightly bullish score, just at 55%, 55.9% strength. That's 60. The variance is very positive, meaning we don't have like much variance from all the data. But when you look at the yield, right, the yield data, yield is still quite in the upside. So meaning the Australian dollar has a better exchange rate, sorry, central bank rate than the US dollar. The high impact data has much more flow into the US dollar than the Australian dollar. So it's bearish at 37%. The recent days is also leaning more into the dollar, but the technical direction still has a bullish view to it, meaning price is still above the 20 moving average, simple moving average. And again, if you look at the leverage fund, the leverage traders are actually trying to buy into this market, as well as the retail traders. Retail traders, they are buying into the market, so I should be a bit neutral. When I say retail, I mean the non-reportable traders. Now, with all of this view on the market, before you go to the charts, there's one thing I kind of expect is going to be happening in this market. Market is going to be in a bit of stagnation, but slowly creeping upwards if it's moving upwards. However, it's looking like a weak move to the upside because the technical direction and the leverage fund traders are the only reason why this market should be going upwards. Let's take a look at the chart and decide what that looks like. So right here we have the daily chart of the Australian dollar against the US dollar, and I'm just going to turn on my recent levels or supply and demand levels I have on the chart. And what I can see here clearly is that we created a supply zone not long ago, about a week, 2 weeks ago in May, the second week of May. We created a good supply zone. And from such supply zone, we've not met with any weekly demand zone. The weekly demand zone is way below. We've not met with the weekly demand zone. And when you take a very good observation at all of this, one thing you'll notice is price seems to be grinding slowly to the upside, just like I expected. You can see it right here. This is a slow grind to the upside. And it's grinding to the upside basically because the leverage fund traders, right, are slowly making it go to the upside. So there is a higher tendency for us to see something like this currently. And mind you, this whole perspective would change in an instant should the economic data release start to show that reason to shift it. And the thing about markets is you can never be 100% right? Not just because we're trying to hedge ourselves and say we can never be 100% right. What I'm trying to say is you can never be 100% right because things change in the market, and what you have to do as a trader is to adapt as fast as possible. And that is basically what this whole thing is. I'm currently having, based on current bias and current situation of the market, I have a bias that price is going to go into that supply zone and then capitulate. If when price is getting into that supply zone, we get a totally new scenario of news events, then I might as well throw away this bias and have a new bias immediately to suit the market stance and everything in the market. But this is basically the current bias I have with Australian dollar against the US dollar, and this is based on, again, the current economic data available as well as the COT report. So I hope you learned something new from this video. If you did, do well to hit the subscribe button, hit the like, share this video with someone who you think may find this trading knowledge valuable to their trading journey. I'll see you all in the next one. Peace.